It is the week of November 14th, and I'm joined, as always, by Mike Rarey. I'm Will Woodall from STRAT. We're going to give you the update for the previous week and talk about things that are happening and going to happen in the upcoming weeks. We'll first take a look at equity prices, and I guess, Mike, the bear market rally part 2, perhaps we'll call it, is continuing here. So take us through the equity prices and give us some of the underlying reasons why we've seen such a strong continuation here of this bear market rally.
Yeah, last week was a beautiful week. Basically, as we go through all these prices, what you'll see is the returns for last week are pretty much the exact opposite of the trends year to date, which sort of is the essence of a bear market type rally. Generally, things have been going one way all year and then they reverse on good news. And the good news last week was inflation finally coming in cooler than expected. The first time we've seen inflation come in this cool relative to expectations since fall of 2020. And how that manifested itself in these returns, if you look at large growth stocks last week, up over 7%, that was pretty much one day. All of these returns for equities were pretty much one day, Thursday, when the CPI print came out, and growth equities had their best day since March 2020.
And we'll talk about the reasons behind that, but just in general, why did growth equities in particular rally off of that move in the CPI?
Yeah, it's all very much related. So the trend has been inflation hotter than expected, which has pushed expectations for the Fed funds rate up higher, which has pushed long-term interest rates up higher. And growth stocks are more sensitive to changes in long-term interest rates than value stocks. When long-term interest rates go up, growth stock present value goes down. And so when we got the opposite of that last week, inflation cooler than expected, expectations for the Fed funds rate coming down, long-term interest rates coming down, large growth stocks were up the most.
And so people are betting that interest rates will come down faster in order to give them better valuations on their growth stocks. Is that sort of the thinking?
The thinking is if you're dealing with any type of discounted cash flow model, you can probably pencil in a slightly lower discount rate.
And maybe we'll talk about this towards the end, but there was also a pretty big relative event because some asset classes didn't move like they had been, particular crypto. And there's been some disruption there. We can talk about that towards the end with the whole bankruptcy that we've been reading about. But any particular comments on how those interest rates, inflation rates impact crypto?
Yeah, so the biggest way is through liquidity. Folks have said crypto is an inflation hedge. Crypto is a hedge against fiat currency debasements. Crypto is a store of value. All these things, to us through our framework, what you see is crypto follows liquidity. It's just the highest beta liquidity asset we've ever seen. And so it makes sense that we're seeing these types of events in the crypto market and these types of negative returns right when we're seeing the fastest liquidity slowdown in history.
Yeah, it is amazing, isn't it? Let's dig into the technicals a little bit and look at the differences between what's happened in dividend-paying stocks versus just general large cap stocks, and then the growth stock market.
Mm-hmm. Yeah, growth stocks at the bottom there, the green line, NASDAQ 100, up 7% last week, and they needed it. It basically just got the NASDAQ 100 back up to where it was late October, which was the tail end of this second bear market rally. So really just sort of back to where they were. That rally is continuing, and perhaps that bear market rally has more legs, we'll ultimately see. But the better place to be all year has been high quality dividend paying stocks. That purple line, the FTSE High Dividend Yield Index, almost back to flat on a total return basis. I mean, getting almost a 4% dividend yield certainly helps. Every little bit counts in a year like this. But seeing tremendous momentum, especially in this bear market rally, it's been high quality dividend paying value stocks that have led the way.
Yeah, it's great. And I guess as we turn away from the equity markets and move on to fixed income, it's about time, but we actually caught a bid on some fixed income.
Yeah. Seeing interest rates come down across the curve right when that inflation print came out. Last Thursday, when CPI came out, the 30-year Treasury bonds had a positive return of 4%. One of the biggest positive return days we've seen in a long time. So once again, what you see last week in these return numbers is just the opposite of year to date.
And moving into alts, same story, pretty much across the board.
Similar story. One nuance here, and it also fed through to foreign equity returns as well. But what we've also seen is China has recently announced new guidelines for how they're going to treat their zero COVID policy and how they're going to implement that. And so they announced 20 new guidelines. And if you read through all of them, it would be nothing we would get excited about here in the States, that's for sure. However, what you see is a lot of folks saying, things like industrial metals are very beaten down because of the slowdown in Chinese economic growth. And if they can possibly get on a path towards reopening, then maybe demand for things like industrial metals would come back. And so you see they're up 15% quarter to date. And if you look back at foreign equities, they had great performance month to date and last week as well. And part of that has been China.
Yeah, I saw the new case count numbers this morning were like mind blowing. I don't know if you have the exact numbers, but they were incredibly high.
Yeah, it's not solving the problem, just managing the problem differently, right? And
right. Yeah, the reaction function, right? Exactly. So we'll see how that plays out. Mm-hmm. Let's move on and talk a little about inflation, because it has been sort of the, no pun intended, hot topic for a while. Mm-hmm. And we saw that decline. We had PPI this morning. We saw it come in below expectations. We're starting to see those trends of inflation turn to what we've been predicting, which is high and falling.
Yep, more and more evidence. We all know we're high. We're still going to be high for a while, but more evidence of falling, which is exciting. And if you go down the line here, these are the month-over-month changes, starting at the top with headline CPI. All those top numbers are food and energy prices. So the good news here, food cooling off just a little bit, particularly food at home, which is nice. But on the headline side, basically the same as September, month over month. So not too exciting. More of the excitement came in the core CPI numbers, and you actually see some blue. So if you look at the goods, the goods section, household furnishings, apparel, if anybody's still looking for any more of that, as if they didn't get their fill during COVID, you're probably getting some sales right now, some good deals. We'll see this when we look through the GDP numbers. Retailers have inventory and they are drawing it down. They are trying to get rid of it as quickly as possible. And so we see that show up in month-over-month declines in household furnishings and apparel prices. And then in the transportation segment, used car prices. So now 4 consecutive months of declines in used car prices. Last month was the steepest decline, down 2.4%. And you recall when we first had this inflation shock, used car prices were the biggest contributor to the surprises to the upside. And now they're starting to contribute to surprises to the downside. This is not a sticky price index, right? Used car prices go up, they go down. But everybody's trying to move cars right now. And if you want to finance that with a 7% interest rate, might get a deal on the price of the car.
For 84 months, yes.
Exactly. Uh-huh. And in the services segment, this is where it gets interesting. So the one that sticks out is medical care services. It's a decent chunk of the CPI basket. It's about 7% of the total basket, down 60 basis points month over month. But there were a couple of items within medical care services that just didn't report last month. So this is something we've been investigating. We're in contact with the BLS trying to determine why we weren't getting prices here, because that plus health insurance could have really swung about half of this cooler than expected core number. So that's something we're digging into, but definitely face value, exciting to see inflation coming in cooler than expected.
Yeah, I think there's a lot of importance on that last statement, Mike, because we're not projecting core to fall as fast or as quickly as headline. And if you go to our next chart, talk about what we're seeing in our forecast.
Yes. And this goes back to the beauty of our framework, right? You look at the knee-jerk reaction from markets up 7% on Thursday when core CPI comes in 20 bips cooler than expected month over month, and you think, oh my goodness, we are off to the races. Inflation is falling. Let's go. Well, we take all of this data through our forecast models, which have tremendous forecasting accuracy going all the way back to the 60s, and see what it actually means for the path of inflation over the next 12 months. And not a whole lot is the bottom line. I mean, we're still looking at the end of our 12-month forecast horizon. Headline inflation year over year running at 5.6, core inflation year over year running at 5.5 12 months from now. And also, we're looking at the month over month changes in this entire 12-month horizon, right? And what we see is even at the end of it, the month over month changes are still hotter than the Fed would like, even at the tail end of this forecast horizon. So that to us reinforces, what our outlook has been in terms of liquidity and what the Fed has to do about this. They still have a lot of work to do. It's great that they're finally getting some sign of progress, but they still have a lot of work to do. And they're probably, even as we get out into March, April, even, fall of next year, they're probably still going to say, wow, we need to keep interest rates high. We can't really start cutting yet. So that just speaks to sort of, our approach, value of our framework. If we were day traders, yes, we would have been excited about the CPI print, but we run it through our fundamental models and see it's not necessarily something to write home about.
Yeah. And I think a lot of people don't understand the pain these higher rates could continue to inflict on businesses and consumers if they remain at these levels or even a little higher for a prolonged period of time. We could literally see these numbers through most of next year at these levels, which is going to make it tough for companies. And we're already seeing signs of companies struggling to meet their earnings expectations. Revenues seem to be good, but earnings are starting to struggle, and you're starting to see big layoffs.
Yep.
Okay. A question on inflation that we were just debating before we came on, and you'll have to remind me what
Politics. How do the politics factor into this?
Yes, indeed. There was quite a, I don't know if these narratives are crazy around election time, but there's quite the narrative of this red wave and how, oh my goodness, once it happens, look out. And then now we have a blue wave happening. So, just make some sense of all of this and talk about the potential impacts, what actually happened could have on inflation going forward.
Yeah, at this point, this far out from election day, all we can say with any type of certainty is we might have a split Congress. I mean, we know the Democrats kept control of the Senate. The House, it looks like the Republicans are going to take the majority of the House. So we have a split Congress. What does a split Congress mean for inflation over the next 2 years? Great question. Well, if you think about over the next 2 years, we're forecasting over the next 12 months over a 50% probability of recession. Why would a recession happen? Well, because the Fed's trying to slow inflation. The Fed's doing a lot of hard work right now. They're raising the federal funds rate as aggressively as they ever have to try to tame inflation, and they're willing to undergo or willing to compromise economic growth in order to achieve their goal of defeating inflation. The big question comes in, when that recession happens, will Congress react with fiscal stimulus like they did during COVID, effectively undermining the Fed, undoing all of the Fed's hard work? Will that happen? And the perception is that is less likely to happen in a split Congress. I don't know who would be more likely to create fiscal stimulus. I mean, it seems like over the past 4 years, Republicans and Democrats were really good at fiscal stimulus, right?
Yeah.
But at least in a split Congress, the hope is in the event of a recession, we will have some fiscal credibility restored or some measure of restraint that at least means we might not have to go through this twice.
Let's hope not. Okay, so going from there, let's just update our liquidity forecast. I don't think there's any significant change. We
Not a whole
continue on
lot.
the same path, right?
Yep, still low and falling, bottoming out right about the same time as we see the terminal Fed funds rate, in the March-April time period.
Yeah. And I think the next chart, though, the economic growth, this is a good indicator of people don't understand. Maybe explain the difference between nominal and real dollars and how GDP is measured and what the numbers that get reported versus what's actually happening underneath.
Yeah. Yeah. For anybody who's, running a business and is watching these videos and saying, you guys are talking about slowing economic growth and heightened recession probability. It just doesn't feel like it, though. It doesn't feel like '08. It doesn't feel like the early 2000s. Well, you're right. It absolutely does not. And that's because you need to look at the economy in nominal terms and real terms. So in nominal terms, what we have here is GDP and all of its subcomponents. They're the lighter hued bars, if you will. And then real dollars. So that's after you subtract inflation. Nominal minus inflation equals real. And those are the darker bars. This is what gets reported. This is how recessions are classified. They're a substantial downturn, widespread downturn in real economic growth, real economic activity. And you look at the difference. Well, in GDP terms, in nominal terms, GDP is up 5.4% year to date. That's excellent. That is not consistent with recessions that most folks are used to right now. This is more consistent with recessions in the 70s. This happened quite frequently in the 70s, where in nominal terms, the economy was going gangbusters, but it was all price increases, no quantity increases. And after expenses, that's where you had multiple recessions throughout the 70s. And all of those felt way different than 2008, way different than the early 2000s. And then furthermore, it's not widespread yet. So based on where your business is operating, you could say, hey, I'm not even seeing a slowdown in real terms, because you look at things like business fixed investment. In nominal terms, up 8.7% thus far in 2022. In real terms, still up 2.9. That's great.
Yeah.
The big negative surprises are residential investment. If you have anything related to housing, doesn't matter if we're talking nominal terms or real terms, the slowdown is real. It's happening. That has been the biggest underperforming area of the economy. And then if you deal with inventory, if you're a retailer, you've been drawing down your inventory like crazy, trying to get rid of inventory. Now you're probably cutting prices, but inventory costs have been significant. So if you operate in those areas of the economy, you've definitely felt it for sure. But if you haven't, well, this probably doesn't feel that bad.
Yeah. Yeah. So what do you think? What is Jerome policy when he looked at this chart? And how does this influence, hey, I'm just going to keep these rates high for a while?
Yeah. He would probably look at it and say, this is kind of best case scenario, for the Fed to have done everything they've done thus far and say, basically, all I've done is forced retailers to work off excess inventory and cut prices. And yeah, I've frozen the housing market. Sorry, I froze the housing market, right? But I'm doing that to try to get rents down, right? That's sort of a means to an end. I'm doing that because in 12 months, it might mean rents come down. But other than that, this is okay. So that's how we would look at it on one hand. On the other side, he'd say, well, I'm still not bringing down inflation too much, because look at the gap between nominal and real, right? That gap is inflation, saying I still have a lot of work to do. So I've already done a lot. It hasn't resulted in a really, really bad outcome yet in terms of the economy. So that's good. But I still have more work to do.
Yeah. Yeah. So for all you pivot hopers out there, it's not happening. Okay. So then with all this, there's still so much talk of recession, and our recession forecast, a little bit unchanged, but over a 12-month horizon, but still signals there's a high probability of recession.
And for much of the year, we were sort of the recession bears relative to consensus. We were saying, hey, there's elevated probability of recession, and a lot of other economists and surveys saying, what are you talking about? And now our outlook looks more mundane. I mean, if you look at the Conference Board CEO surveys in Europe, they're saying 99% of CEOs think we'll be in a recession. In the US, it's like 98%. It's ridiculous.
Yeah.
Their Bloomberg consensus now is over 60%. So, we were definitely early to it. Now everybody's sort of on board with recession coming in the next 12 months. Just interesting to see how that's evolved throughout the year.
Yeah. So the next chart we've put in, it's a little busy, so you have to walk people through it here. But we use this internally as a component of one of the recession indicators. So take us through what we're looking at here.
It's my oldest son's favorite chart. His favorite color is rainbow, so this is perfect. But what we're looking at, we've talked a lot about the yield curve and yield curve inversions, and these are wonky terms, and sometimes they're hard to visualize. So this is our effort to make it easier to visualize. But what we're looking at are different treasury yields. So the 3-month yield, 1 year, 2 year, 5 year, 10 year, 30 year. And this just goes to show what we're talking about. When the 3-month, that shortest maturity treasury, is offering the highest yield of all those different maturities, that is a problem. That is when the yield curve is inverted. That is called the smartest economist in the room. That has preceded every economic recession since World War II with a lead time of about 6 to 18 months. And you can see where we're at now. The 1 year and the 2 year are slightly higher than the 3-month. This flows right into our recession forecast. We do the percentage of the yield curve that is inverted. Right now, about 2/3 are inverted. But this is a big component as to why 12 months out, we think there's a high probability of a recession. Anybody in the economy that is in the business of borrowing short and lending long is not making any money. And when they're not doing that, the credit cycle stalls. When the credit cycle stalls, growth momentum stalls. And so that is, it's currently happening. And, this is exactly what the Fed has manufactured. It's probably going to continue to happen.
Yeah. Yeah. It's every day we continue to see more and more inversions, and we don't see a lot in the bond market signaling that things are okay. And I'm just going to front run. I'm sure one of the questions that we always get is this an equity market bottom that's forming?
Yeah. Well, we don't think so. We would like to see, so think about what we would need to see to say equity market bottom. We would want to see the yield curve steepen, right? All we're talking about is flattening. When we say flattening and inverting, those are all the bad things, right? That's all that's happening. We would want to see the yield curve steepen. We would want to see liquidity tick up, to even be close to high and rising. That would be nice. And we'd want to see economic growth bottom. And then the last thing we'd want to see would be stock prices actually bottom and start to come back up. I mean, just, looking for exactly what we're looking for, right? If you want to see equities bottom, well, then they have to actually bottom and start coming back up. And we still haven't seen that yet. So, yeah, no, this is not what an equity market bottom looks like within our framework.
Right. So I guess what Mike's saying, there's a lot of other things we would have to see, and we're not seeing any of those things at the moment. If we do, we would certainly be signaling those to you and letting you know that we're seeing the turn here. But right now, it's just we're looking at earnings. Like, maybe give some update and some commentary on earnings that we've seen so far and what kind of picture they're painting for Q4.
So for Q4 and Q1 and even into Q2, you're looking at very low single-digit earnings growth as consensus now. So expectations have come down quite dramatically. There have been some big misses. On the revenue side, it's definitely not that bad. And that's why you've seen companies start to really try to manage costs aggressively. You spoke to it earlier, some big high-profile misses along with big announced layoffs and hiring freezes. So the earnings momentum, particularly if you exclude the energy sector, pretty much the consensus is it's going to grind to a halt. And the hope is back half of next year, we can start to see a recovery. But that's always the hope when sell-side analysts try to project earnings, right? They can
Yeah.
usually see 3 to 6 months out, and then from there on out, it's earnings are just gonna grow. So we'd like to, we would say prove it, or at least have our framework say that would be a conducive environment for earnings to grow, which we're not quite there yet.
Yeah. Well, I think we'll leave it there, but we'll be out next week for Thanksgiving. We hope that everybody has a wonderful and safe and fruitful Thanksgiving. And thanks for joining us. We really appreciate you tuning in to join us as we talk about these markets and as we march on our journey here forward, because it's been quite an interesting year, one of the most interesting so far in history based on where the returns have been, and it's going to be an interesting close to the year. So we'll look forward to coming back to you in early December and picking this back up. And in the meantime, if you have any questions, reach out to us.